Hi, everybody. Rebecca Walser from Crashes and Taxes, and so glad to be joining you on this episode of Crashes and Taxes. This is probably going to be one of the most practical episodes of Crashes and Taxes that we've ever done. And I am so excited to actually go through this episode with you because this is the ins and outs of what my practice and my team does when you actually call and want to see about potentially working with us. We do some really quick, usually within, I'd say by if the first meeting is a phone call to make sure that what you're looking for is what we can deliver. And then after that meeting, we move right into an actual meeting, whether it's in our office in Tampa or if it's virtual. Most of our meetings are virtual because we have clients all over the country. And that very first meeting, we start to assess what your needs are and we start to do some actual financial analysis, which is so incredibly powerful and can be so rewarding if you just take the time to do it. And so what we're going to talk about today is what is your wealth gap? What is your cash flow gap? And these are two of the biggest things. If people can just literally figure out, okay, this is the amount of income that I want to have for the rest of my life, and then this is what I have right now, and therefore this is what my gap is, then you can really reverse engineer. And that's what I specialize in doing, that we reverse engineer. If you start at point A and you want to end at point B, what do we need to do to get from where you are to where you want to end? So we always begin our planning with the end in mind. What do we need to accomplish to get and achieve what you're looking to do? And it's amazing to me how many people just simply have no idea what they need to be doing. And what I find a lot is, and this is not for, obviously we deal with a lot of higher net worth people and higher income people, and they're not just doing the standard 401k. But I want to tell you that what the default American plan out there is for people that do make enough money to really put money towards retirement, because a lot of Americans don't make enough to contribute anything towards retirement. And that's not our target audience, because that's a client that we really can't help. What are we supposed to do with that person? But for those people that really can put money towards building a retirement and a nest egg and really building wealth, they naturally default to what they can put into their work plan. This is a function of the 401k that's come about since the very early 80s. It was written into the Revenue Act of 78. And people have just naturally kind of just said, well, I put in the maximum to my 401k. I get whatever match there is from my employer. And so therefore that's what I do. And if that's not enough, they haven't even considered that might be not enough. And the math is really, really basic. Let me see if I can get you an example. So I have a couple of rules here I want to share with you. So let's say that we're talking about a potential client who is making $75,000 a year. So we've got $75,000 a year. And the first thing I want to tell you is my rule of 70. So what's my rule of 70? Well, first of all, a lot of people have no idea what they need to live off of when they retire. And so let's say that somebody's making $100,000 a year. And I say, what do you want to live off of when you retire? And they tell me, oh, my bills aren't really high. I could live off of $30,000. And so then, of course, naturally in my brain, I'm like, okay, $100,000 a year. Let's leave out state income taxes for just a second. Let's just talk federal tax for a second. Let's say that at $100,000 a year, their effective tax rate is probably around 13%, maybe less, depending on their deductions. So if you've got a 13% federal tax rate on a $100,000 salary, you've got literally, this person's got $13,000 of federal taxes. Of course, there's payroll taxes too. So maybe our net cash flow is, let's just call it an even $80,000, not including any kind of state income taxes. So just from the federal tax and the payroll taxes, we're like at $20,000 deduction. So we're at $80,000. Now, if they're making take home 80 and they're telling me that their bills aren't that much, they can live off of 30, then what's happening with that difference of $50,000 a year? So that person, I would expect, has got lots of money saved up if they've been working at that level for a while in their savings. So I'm like, okay, so are you saving $50,000 a year right now? And of course, the immediate response is, well, no, of course not. Who's saving $50,000 a year when they're making 100? So they're like, no, not not saving $50,000 a year. So definitely they're living off of more than just the $3,000 a month. So their bills might be $3,000 a month, but they're going out to, well, when we were open and things were normal, they're going out to parties, to clubs, to bars, to restaurants, eating out, to movie theaters, whatever people do and spend their money on, they're doing it. They're going on vacation. They're doing all these things. So the question is, even if technically your bills are $30,000 a year, if you're making an income of 100 and you think that you can drop down to a lifestyle of 30 in retirement and you're going to feel like you did a good plan, you're going to feel like you're poor and you're going to feel like you have hit, Skid Row. You're not going to be happy about that. So the first rule I have, if you don't have any idea what you kind of want to live off of, is the rule of 70. We like to plan on you maintaining an income cash flow level of at least 70% of your previous, pre-retirement income. So 70,000, 70% of 70,000, you're looking at somewhere in the $52,000 range. We want you to have cash flow of at least $52,000. Now, if you tell me, no, Rebecca, I can definitely live off of 30, I'll be fine, then we're not going to fight you. We'll say, okay, 30 it is, but our normal rule is the rule of 70. Now, my next rule comes to those of you that are under 50 years of age. So really 55 and under should be the age now especially, but I was just going to say the rule of 50. If you're 50 years old or less, probably really 55, we are not going to count on any Social Security for you in any kind of income plan. There is too many reasons to tell you why we're not going to count on Social Security for you. That's a podcast unto itself, but trust me when I tell you. And for those of you that are just listening to this podcast and not watching on the video cast, I am holding up a whiteboard with actual rules. So if you can check out the video podcast, that's great, but I'll walk you through it. So my rule of 50 is if you're 50 and under, and again, really 55 and under, we're not counting on any Social Security. And there's a lot of reasons why I have a podcast just about Social Security. We can check out those later. But right now, understand that we're getting no fixed income from the government if you're that young or under. Of course, if you're 55 and older, we'll give you some kind of Social Security, but we are going to means test it because all Social Security will be means tested by the end of 2030 at the mass retirement of the baby boomers. There's no doubt about that. The math does not lie. So we start with, what does your income need? Number 2, can we count on any kind of reliable Social Security? Number 3, if we can count on Social Security, we're going to means test it. We're not going to take your full benefit and just say, here it is, and that's what you're going to count on. It's extremely rare that we do that. You have to be a certain age and you have to meet certain requirements. So then we start to figure out, okay, what has to be what we call self-generated? What am I actually responsible for generating for the rest of my life? And the way we get your generated dollar number, you can see right here on my little whiteboard, is we are going to take the number that we settle on as your cash flow and we're going to subtract your fixed income. Your fixed income could be Social Security. It could also be a pension if you're lucky enough to have some kind of pension, some kind of guaranteed income. We're going to give all of your fixed income consideration to get to what the generated income number is. And this is the ultimate goal because this is what you are responsible for generating. You might have been able to tell by now, if you're 55 and under, that's pretty much everything. You're going to be responsible for providing your full cash flow in retirement. And if you get, by some miracle, stroke of, a miracle, you get Social Security, then that will be a benefit and a plus. We're not going to count on it for the purposes of the income plan. So now that we have your generated income number, we know what you have to actually generate for the rest of your life. We're going to start to figure out what kind of gap do we have. Okay, I need to generate, if I'm, wanting to get to $52,000 a year, clearly I'm under 55, in case you didn't know. And so if I need $52,000 a year, I need to self-generate $52,000 a year. And here's where the biggest revelation comes. Most people have no idea how much of an asset class they need to have to actually generate $52,000 of income per year. So a general rule of thumb, this is definitely not sophisticated financial analysis that we would be doing if you were walking through with us as a client, but a general rule of thumb is 4 to 5% cash flow from your asset. So let's just say that you have an asset that's $1 million. Let's say that your 401k, which is a whole nother problem, but let's say your 401k is $1 million. Well, 4 to 5% means $50,000 on the upside. So if I need to self-generate $52,000 of income per year, then that's an asset level of at least $1 million per year to generate that level of income. But what have I missed in that whole equation I just gave you? It's so interesting. I just thought about this week because I was talking with a client this week, a new client of ours, and we were going through this income analysis generation wealth gap process. And they said to me, should I convert what I've already built in a 401k to Roth? And I said to them, let's let the math answer the question. And so when we finally got to the self-generated number that they were going to be responsible for doing, and we saw how much actual money that person needed to have to generate that self-generated number, and that person was extremely short in this particular case of having that amount of asset level, it was very clear and very apparent from this very first meeting with me, after having gone through some people on my team, it was very clear and very apparent that we had to make up a substantial amount of building wealth before their retirement just to get to enough of an asset level to generate that self-generated number. And so if we have to use every last year we have to build a gap to get the asset levels built up to enough of amount to generate a number that we need to get to their cash flow, the question is, do we have any excess capacity to take money from that cash flow to pay taxes? If they want cash flow to live off of, let's just use our same example of 52,000. If they want cash flow of 52,000 and we have a gap and we have to take all the years we have left until retirement to fill the gap to get to that $1 million level to generate that 52,000, can we then afford to pay taxes from that 52,000? And of course, you are now thinking of the answer yourself. And of course, the answer is no. If we are so short in our wealth account that we have to build it up over these next several years just to have enough of a distribution to get to the number that we need, then we don't have any room for taxes, which means that the wealth account that we're building needs to be tax-free. It just absolutely needs to be tax-free. And then when you consider the fact that we know where taxes are headed based on what the Congressional Budget Office forecasted for us in 2008, which again is shocking unto itself, then that will doubly tell you that absolutely not everything needs to be tax-free. And then we need to figure out, okay, what are our tax-free asset class options? And so this is kind of the foundational basis of how to calculate, do I have a wealth gap? Am I on track for when I want to retire? There's this whole thing called FIRE. I don't know if you guys have heard of FIRE, but FIRE is this taking over a lot of millennials right now, and it's about really working and grinding it out for so many years really fast to build up so much of your asset base. You kind of live like a pauper almost for several years, but you put so much into your future wealth bucket that you're able to retire, at a really young age, I think even before you're in your 40s. And it's really taking hold. A lot of people are doing it right now. And if you're doing that, if you're a FIRE, believer and you want to build up quickly so you can retire early, you absolutely must do these calculations, and taxes has got to be a consideration of what you're doing. But if you don't know if you're on track for how much you want to have as cash flow for the rest of your life, if you don't know if you should be counting on Social Security or you shouldn't be, and to what extent you should or shouldn't be, if you don't know what kind of income your existing assets will generate. And remember, if you've already built up, let's say you've already built up 300,000, but you're only 45 and you want to work until you're 60, well, that 300,000 is going to grow between the ages of 45 and 60. So now we need to do some compound return assessments to see how much that $300,000 is going to be worth at 60 to then generate the cash flow. There's a bunch of steps and all of this analysis that obviously as professionals we do every single day. But it's a lot of information that really needs to be assessed. And what I was really struck with this week by a couple of new clients is that just people just don't know what their wealth gap is, what their income level is that they even want to live off of, whether their asset classes should be built taxable or tax-free, what the options are on the tax-free side. There's so much information, and all of it means you need to have an integrated plan. Integrated plan from a tax perspective, integrated plan from an asset class perspective. Where are we building this wealth? Is it stable? Is it something that's going to crash and burn and rebuild and crash and rebuild? We need to figure out all these things holistically together to make sure that when you're getting to the point of being at point B, that you're actually where you want to be, and that you can retire, stop working, retire early, just have built enough wealth to live off of for the rest of your life. I have one more little note to share, and that's with real estate investors. There's a lot of tax developments on the real estate side that make building an entire portfolio in real estate very, very, very dangerous. I am so pro real estate. It's been one of the best long-term inflation hedge protections there is. But I will caution you sincerely to not build your entire portfolio in real estate because of the tax law changes that will come even before 2030, I expect, in the real estate world and in the long-term capital gain world, and at what we call the 1014 step up at death world. So that's another tax law topic for another day. But today, to recap, you need to, number one, clearly define the income level that you want to retire with. Number two, if you don't know what that is, use the rule of 70 and track and plan on at least 70% of your pre-tax or your gross income. If you're 55 and under, use the rule of 50, meaning don't count on a penny from Social Security. I can explain why if you have a question. And then from there, take whatever your income level is that you want to have once you're fully done working full time and subtract from it any fixed income sources you have. Once you subtracted fixed income sources, which would include Social Security if you can count on it and if you are going to get it, then you have what we call your generated income number, or the number that your portfolio and your assets that you've accumulated by the time you retired are responsible for generating for you for the rest of your life. And to give you a roundabout calculation, take about 4 to 5% cash flow per year, and that will give you a roundabout number. So if I have $1 million of accumulated assets, 5% would be about $50,000. That's before taxes. So if my assets are taxable, if they generate taxable income, I'd have to then consider taxation. If my asset classes are tax-free, then I would not have to consider taxation. This is Rebecca Walser for Crashes and Taxes, helping you to find and fill your wealth gap. I cannot wait for next week.